I mean, from an investor standpoint, probably, especially in nominal terms. I mean, in emerging markets, when they go through issues, usually things go up in their local currency term, even if they do poorly in dollar or gold terms. And I think what we're generally seeing is some of these developed markets, especially the US, have certain emerging market characteristics, just to a less extreme degree. Um, and so if I had a view that they were going to dramatically cut the deficit tomorrow, then I would invest differently. I would own things like I would own more bonds, for example. I would own more of those types of assets, and I would own less equities and less of these other real assets. But because I don't expect them to do that, I invest the way that I do. So yeah, you could say it's bullish on the assets that I want to own if those deficits continue, but that's why I've invested in them in the first place. It's a higher nominal regime overall. Um, and it can sometimes lead to a higher real regime if you're kind of sucking monetary capital out of other countries like places in Europe or places in Asia, for example. If the US is running this playbook, but investors are still fueling it because they don't know where else to invest, the risk comes when they do feel like they have alternatives and this spending's still locked in. And so if you get a repudiation of the bonds while this is still happening, they don't really have a way to slow it down. That's where you could get more obvious inflation risks or things like that.
In this exclusive interview, Lyn Alden sheds light on a concerning trend in the US economy. Over the past 40 years, deficits and debt accumulation have been met with declining interest rates, offsetting the rising debt to GDP ratio. However, with interest rates no longer declining and potentially rising, there's a growing concern about the sustainability of the current fiscal trajectory. Alden highlights the complex interplay between fiscal policy, interest rates, and the financialized nature of the economy, warning of potential challenges ahead.
So for the first one, fiscal dominance is basically when, you know, so monetary policy is things like interest rates or central bank balance sheet. Fiscal policy is like taxing and spending decisions by the government. And fiscal dominance is when that latter has a much bigger impact on the economy than the former. And more specifically, it's when the former, whose tools are meant to control inflation, are no longer able to control inflation because most of their tools are geared toward the private sector, whereas much of this is happening from that fiscal side, from the public sector, and central bank tools don't really address the fiscal side. Another way of putting it is that in an era where there's no fiscal dominance, higher interest rates should lower inflation because you're softening private sector credit creation and you're strengthening the currency from the perspective of foreign investors. But in a high public debt fiscal dominance regime, higher interest rates are not always negative for inflation because although they do put downward pressure on some of those private sector things, they put upward pressure on the fiscal deficit due to higher interest expense. And that's partially what's fueling inflation in the first place. That interest expense by the government is someone else's income, right? So for example, if I use myself as an example, I have a fixed lock-in mortgage and I have money markets. If they increase interest rates, they increase my income, which I can spend, right? And I'm not the only one like that. There's many corporations in that position. There are many households in that position, ironically. And so if the private sector termed out their debt and the government has not, and specifically that those levels are very high, that's where it starts to get a feedback loop that is not in line with what the past 40 years have been. And to answer your second question, why are they spending so much? I would say, I mean, a lot of it's locked in. It's demographics. It's political. It's a gridlocked Congress. It's military spending. It's geopolitical. It's all the above. But I think the broader, more structural thing is that over the past 40 years, there's been constant deficits for the most part, rising debt to GDP, but that's been offset by 40 years of declining interest rates. And so interest expense was never really a problem. If you double your debt, but you cut your interest rate in half, then your debt servicing costs are not really a problem, right? And so it's been 40 years of that math happening. And the problem is that if you are continuing to rise public debts and deficits, but your interest rates go all the way to zero and bounce off zero and then start going sideways to up, you no longer have that offset anymore. And so I think that's the bigger factor for what's happening is that the kind of the natural conclusion of decades of deficits and debt accumulation is that we kind of enter this new period where interest expense starts to actually matter and they start to enter this kind of long-term fiscal spiral, which again doesn't mean anything major happens this year, but it means that this overall kind of fiscal train is not going to stop anytime soon. And it's this new background structure that as investors or any of us operating the economy have to contend with, that it's a different background structure than the prior decade. I mean, from an investor standpoint, probably, especially in nominal terms. I mean, in emerging markets, when they go through issues, usually things go up in their local currency term, even if they do poorly in dollar or gold terms. And I think what we're generally seeing is some of these developed markets, especially the US, have certain emerging market characteristics, just to a less extreme degree. Um, and so if I had a view that they were going to dramatically cut the deficit tomorrow, then I would invest differently. I would own things like I would own more bonds, for example. I would own more of those types of assets, and I would own less equities and less of these other real assets. But because I don't expect them to do that, I invest the way that I do. So yeah, you could say it's bullish on the assets that I want to own if those deficits continue, but that's why I've invested in them in the first place. It's a higher nominal regime overall. Um, and it can sometimes lead to a higher real regime if you're kind of sucking monetary capital out of other countries like places in Europe or places in Asia, for example. If the US is running this playbook, but investors are still fueling it because they don't know where else to invest, the risk comes when they do feel like they have alternatives and this spending's still locked in. And so if you get a repudiation of the bonds while this is still happening, they don't really have a way to slow it down. That's where you could get more obvious inflation risks or things like that. So it's one of those things where in the early stages, it does feel pretty good. And it's the later stages where, yeah, you really get the consequences from doing that. But yeah, I do think that overall, investment decisions have to take into account the deficit. And part of why I'm long certain assets is because of that. And the last point I would make is that the challenge when they get to these high debt levels in this financialized of an economy is that even if they try to do austerity, even if they try to say raise taxes and cut spending, that would be bearish for a period of time. But then the problem is that tax receipts are so heavily correlated to asset prices now because you become so financialized that by cutting that, you would likely depress asset prices for a period of time, which would then ironically increase the deficit again. And so it's actually a very hard tailspin to get out of fiscally when you have the combination of this high public debt built on this financialized of an economy. If you had one or the other, it's easier to do. If you have a financialized economy but not a highly indebted one, you can start to definancialize it gradually. If you have a highly indebted public sector but it's built on a non-financialized economy, then austerity might give you options to deal with that. But if you have that combination, that's super hard to work with, especially when you're trying to work with it with a gridlocked Congress. There's really not that many outcomes I see that change that, which is why I invest structurally the way that I do.
In this segment, Lyn Alden delves into the implications of running large fiscal deficits within the context of abundant energy and technological advancements like AI. She explains that if deficits are used to invest in productive assets such as infrastructure and technology, they can help keep inflation in check by increasing the supply of goods and services. However, if deficits are directed towards consumption or non-productive expenditures, they may lead to inflation, primarily manifesting in asset prices rather than consumer goods. Alden suggests a balanced investment approach, advocating for holdings like gold, Bitcoin, and energy stocks, while exercising caution with highly valued growth equities that could be vulnerable to inflationary pressures.
So that would happen in the context where energy is abundant, right? So a lot of new energy supply is coming online to kind of keep up with that. And two, you have deflationary offsets from things like AI or other tech. So for example, if you ran very, very large deficits, but those, for example, if you ran very large deficits, but you used it to, go get copper mines and build nuclear plants and data centers and things that were highly productive, it might or may not be as effective as the private sector, but at least you'd bring new supply online at the same time as you're debasing your currency, so you can minimize how much on a kind of a per currency basis, these things are getting more expensive, if at all. The problem comes in when you run this big fiscal deficit, but it doesn't go toward increasing the supply of goods and services. It goes more toward consumption or more toward locked in demographics or towards war or things like that. They're not really kind of fueling that real GDP growth. And so it to the extent that AI or energy abundance helps keep CPI down, but you're still running these big deficits, then that inflation will generally show up in asset prices. It'll show up in things like gold and Bitcoin and high quality equities and high quality real estate. That's where that inflation will show up. Whereas if you do get energy bottlenecks or AI does not offset things as quickly as some people expect, then more of that would show up in CPI. And you'd be a little bit more careful of some of those, high multiple growth equities, for example. So if you're not sure about this kind of the ratio of where that inflation will end up, then one thing you can do is kind of invest in the middle, which is to say own things like gold and Bitcoin and energy stocks, for example, and kind of high quality assets like that, but still be cautious around the most highly valued growth equities that might get punished if some of that inflation does show up in the CPI.
Thanks for tuning in today. In this insightful discussion, Lyn Alden highlighted the concept of fiscal dominance and its implications for the economy. She explained how rising deficits, coupled with changing interest rate dynamics, could lead to significant challenges in managing inflation and fiscal policy. Alden also discussed the importance of understanding the interplay between fiscal policy, technological advancements, and asset inflation in guiding investment decisions. Don't forget to subscribe to our channel for more thought-provoking content, and remember to like and share this video. We value your opinions, so feel free to share your thoughts in the comments section below.